Let's take a look at stocks versus bonds and which one is better to invest in. I'm Rachel Jones and you're watching kalkinemedia. Now, investing money is crucial to help generate wealth. Inflation, or money losing its value over time, has been a significant issue for investors in the prevailing economic climate. Tackling inflation with a savings account is not really feasible in this low interest rate environment. Therefore, it's important to invest your hard-earned money more strategically. Stocks and bonds are some of the most popular choices of investment vehicles in the market. But before investing, it is important to understand the differences between the two. The first and foremost thing to keep in mind while considering stocks and bonds is to understand that stocks provide you with partial ownership or equity in a company, while bonds are a loan which a company or government takes from you. There's a huge difference in their method of profit generation. While stocks generate profits for investors through appreciation of their value and are later sold at a higher price in the stock market, bonds provide investors with returns as a form of fixed interest over time. Equity and debt markets are generally used as a reference for stocks and bonds respectively. As compared to stocks, bonds are usually considered as a more conservative market instrument, as they come with a promise to pay a fixed rate of return, unlike stocks. The fluctuating value of bonds won't have an impact on the assured yield on your initial investment. However, the returns might be lower than what you generate from stock investments. Stats show younger investors are more likely to go for stocks instead of bonds. One of the major reasons for this is that young investors have the luxury of time to recover from losses. Additionally, young investors don't usually have family responsibilities. Stocks provide investors with partial ownership, potentially huge gains, enhanced liquidity, dividend payments, and help the investors in beating inflation. In case of a company going bankrupt, stockholders are the last ones to receive their payments. Bonds, on the other hand, provide investors with protection against losses and are less volatile. In case of bankruptcy, bond investors are paid before the shareholders. However, the returns that investors get on bond investments are much lesser than stocks, and bond investors also face a higher liquidity risk, as it's not easy to immediately sell bonds. Also, investing in bonds requires large amounts of money, as they are sold in fixed denominations, while stock options range from penny stocks to stocks worth thousands of pounds. So, in conclusion, diversification of portfolio is the key to smart investment. Investors should conduct detailed research to have a deep understanding of the market before jumping into the pool of investments. Now, if you like this information, please like, share and comment on this video and subscribe to our YouTube channel. You can also press the bell icon, and that will be for notifications for our other videos. I'm Rachel, signing off for now.